Okay, let's unpack this. We are diving deep today into, well, a really complex story unfolding in transportation. It's the Q3 2025 results for Norfolk Southern Corporation, NSC.
Yeah, it really is a story running on two parallel tracks, isn't it?
Yeah.
On one side, you got the company trying to show, these underlying productivity improvements, big ones. But on the other, they're grappling with, frankly, staggering costs from that major incident and planning this massive, potentially game-changing merger at the same time.
Right, that dual challenge. It makes just reading their standard financial reports almost impossible, actually. So, our mission today for you listening is pretty simple. We're going to try and cut through all that complexity in the reporting. We want to isolate the core performance indicators and really figure out how these two huge external factors, the Eastern Ohio incident aftermath and that pending Union Pacific merger, how they're really shaping NSC's story right now.
And we absolutely have to start with a heads up, maybe a warning. Because the reported numbers, they can be really deceptive. So the initial snapshot, it shows NSC reporting $3.1 billion in revenue for the quarter. Okay, that's a modest 2% growth year over year. Volumes were flat. But, and this is the key part, to understand if the company is actually, healthy operationally, we basically have to ignore those traditional GAAP numbers and go straight to the non-GAAP figures.
Okay, let's slow down there for a sec. Because standard reports use GAAP, generally accepted accounting principles, but you're saying for NSC, right now, GAAP is almost a distraction. Why is it so misleading when you compare year over year?
Well, it's misleading mainly because the GAAP results are just completely skewed by these one-off special items. So like if you look at the Q3 2025 GAAP operating ratio, 64.6%. Okay, looks maybe a bit weak. But then you look back at Q3 2024, the GAAP operating ratio was 47.7%.
Whoa, that's a huge difference. You'd think the company just fell off a cliff operationally.
Exactly. But it's not really about operational decline. The difference is that the prior year's numbers, 2024, they were artificially boosted massively by a $380 million gain from selling off some railway lines. That huge one-off benefit just makes any direct comparison between 24 and 25 totally useless unless you adjust for it.
Okay, got it. So we strip out that noise, the non-recurring stuff, to see the actual operational picture.
Right.
So focusing then on those adjusted Q3 2025 results, what's the sort of first sign of underlying health we should look for?
The key metric really is the adjusted operating ratio. It came in at 63.3%. And this is critical because it actually represents a 10 basis point improvement over the adjusted 63.4% OR from Q3 2024.
Basis point. Okay, that's classic finance jargon. For someone maybe not swimming in these terms daily, how should we think about a basis point improvement? Is 10 a lot?
Yeah, good question. Think of it simply. 1 basis point is just 1/100th of a percent. So 10 basis points, that's just a 1/10 of 1% improvement. Doesn't sound like much, maybe. But in the railway world, where margins are super tight and operations are just massive scale, even a 1/10 of a percent decrease in your operating ratio, well, it signals genuine success. It means they're controlling costs better, running trains more efficiently.
So a small decrease in that ratio, and just to quickly define it again, that's the percentage of revenue eaten up by expenses. That small decrease is a win. Okay? And what did that efficiency mean for the overall bottom line?
It flowed right through. Adjusted diluted earnings per share, EPS, hit $3.30. Now, that's a 2% increase from the adjusted $3.25 in Q3 2024. And getting any upward movement like that, considering everything else going on, that's pretty remarkable.
That efficiency engine sounds promising, yeah. But, 10 basis points isn't exactly a massive leap. Is there maybe a risk these productivity gains are just kind of masking softness in some core revenue areas? I mean, we know overall traffic volumes were basically flat, right? Year over year, about 1.8 million units. So where did that 2% revenue growth actually come from?
Okay, so that brings us right to the revenue deep dive. And you're right to ask because the growth story is very concentrated. It's pretty much all coming from the merchandise segment. That's NSC's main freight engine, carries everything, cars, chemicals, lumber, you name it. Merchandise revenue was up 6%, and that directly mirrored a 6% increase in volume in that segment.
Okay, and within merchandise, was there like a star player driving that?
Oh, hands down, automotive. Automotive volume and revenue were both up an impressive 18%. And the reports point to two things there. One, just sustained growth with their existing manufacturing customers. Good base business. And two, a bit of a push by shippers to increase volume now. Maybe, anticipating future tariff changes or just general supply chain jitters. They wanted to move stuff.
Right, strong demand there, timely demand. And we also saw some strength in related industrial stuff too, didn't we? Chemicals.
Absolutely. The chemical segment also saw a solid 10% volume rise. But this wasn't really consumer demand driving it. It was mostly industrial inputs, specifically natural gas liquids heading for export markets, and also more sand shipments to support natural gas drilling. So, yeah, strong industrial activity, particularly tied to energy, seems to be a big theme for their core merchandise business.
Okay, now for the flip side. If merchandise was up that much, but total volumes were flat, something else must have been pulling things down. Let's look at intermodal first.
Yeah, intermodal was definitely soft. That's the segment moving containers, the big boxes you see coming off ships. Revenue there was down 1%, volume slipped 2%. And drilling down, domestic intermodal volume decreased 3%. Management pointed to less traffic coming off the West Coast and just generally fewer high-margin premium shipments. Kind of a slowdown there.
And the final piece of that revenue pie is coal. That segment always seems to instantly reflect what's happening globally, doesn't it?
It really does. It's a perfect picture of divergence this quarter. Overall coal revenue, down 12%. Volume dropped 5%. The weakness was clearly external. Export tonnage fell a sharp 16%. That's because of soft global demand and just unfavorable prices for seaborne coal. The global market weakness hit them hard there.
But domestically, they actually saw a bit of a boost.
Yeah, exactly. The strength came from utility tonnage, which actually increased 6%. And that was driven by higher electricity demand here, plus higher natural gas prices, making coal look, comparatively more attractive for U.S. power plants. So domestic utilities kind of propped up that segment despite the big global headwind.
And speaking of headwinds, there was another one they were fighting against from the commodity markets, right? Fuel surcharges.
Yeah, a really relevant detail, actually. Because fuel prices, the commodity prices, were lower than in Q3 2024, NSC saw a $30 million drop in the revenue they collect from fuel surcharges. Now, that alone acted as a 1% drag on their total revenue growth.
Ah, okay. So that makes that 2% adjusted revenue increase we started with seem, well, even more impressive. They had to climb over that market factor just to get there.
Exactly.
So given they are earning that small revenue increase and managing to improve their operating ratio, we need to know how they're doing it. How are they controlling costs and reducing risk? This takes us to where the company is claiming, tangible wins, operational excellence.
Right, and this is where the story shifts a bit from pure finance to, well, engineering and operations.
Yeah.
We saw that 10 basis point improvement in the OR. That's tied directly to them accelerating their cost-cutting commitments. NSC actually raised their 2025 productivity target projection. They now expect to save around $200 million, which is up quite a bit from their original $175 million target. So they're finding efficiencies faster than planned.
Okay, productivity improvement is one thing, but safety. Safety's got to be absolutely top of mind, especially given their recent history. How are the sources assessing their safety performance?
Well, they seem to be translating that commitment into measurable results, which is key. The company is reporting better performance across all three major year-to-date safety metrics compared to their own 5-year average. That includes the FRA Personal Injury Index, the FRA Accident Rate, and the FRA Mainline Accident Rate. And the FRA, just for context, that's the Federal Railroad Administration, the main regulator tracking this stuff.
Right. And that improvement in safety and cost control, it sort of culminated in one big headline-grabbing achievement for the quarter, didn't it?
Yes, absolutely. The biggest single operational win they highlighted was hitting an all-time quarterly fuel efficiency record. I mean, in an industry where fuel is consistently one of your top 3 operating costs, getting consumption down to a record low, that's a huge operational victory. Directly helps lower that operating ratio we talked about.
And let's connect that efficiency push to the technology they're using for safety. They're investing heavily in this system, the Premier Wheel Integrity System. What's the scale of that thing?
Oh, the scale is, it's genuinely staggering. This is a really advanced preventative maintenance technology. They're installing it on their main lines.
Yeah.
And it's capable of inspecting roughly 4.2 million axles per day.
Whoa, hang on. Let's just pause on that number. 4.2 million axles daily. That's not just big data. That's like fundamental real-time risk management across their entire network. Why is that tech so critical right now?
Well, it fundamentally shifts maintenance from being reactive, fixing things after they break, to being predictive, catching problems before they happen. By using all these sensors, they're finding tiny flaws, potential issues, before they can become major failures. And the impact seems immediate. They reported a 36% year-over-year reduction in wayside stops. That's when a train has to stop because of some kind of alert. And maybe even more importantly, they logged over 40 critical wheel integrity algorithm intercepts just in Q3. That means they likely prevented 40 potential wheel failures before they could cause an incident.
Hmm. That level of preventative action, it takes us straight to that other major external issue dominating their financials, the Eastern Ohio incident. And here we need to be really careful, maintain strict impartiality, just look at the financial reality reported in the 10Q filing.
Right. So since the incident first happened, the cumulative total net expenses directly tied to it stand at $1.2 billion. That's the running total. But crucially, the sources also show they've managed to secure $1.1 billion in recoveries, think insurance, potentially other settlements to offset those costs.
Okay, and what was the specific financial impact just during Q3 2025 itself?
Well, interestingly, in the third quarter, the financials actually showed a net recovery of $11 million related to the incident. That happened because the $16 million in recoveries they booked during that period actually exceeded the $5 million in expenses they incurred in Q3. And also importantly, from an operational environmental perspective, they officially completed the remediation and restoration work at the site itself in September 2025.
Okay, finishing the site remediation, that's a huge milestone. But the legal story, the litigation, that's far from over, is it?
No, not at all. The sources confirmed that the big $600 million Ohio class action settlement, yeah, it got final approval back in September 2024, but that settlement is currently under appeal. So while the physical site work might be done, the final legal bill related to that specific settlement is still kind of up in the air pending that appeal resolution.
And as if that wasn't enough operational distraction, NSC is right in the middle of navigating the biggest strategic move in the whole sector, that proposed Union Pacific merger.
Yeah, this agreement was announced back in July 2025. Big news. It's a proposed stock and cash deal. The plan is for NSC shareholders to get one Union Pacific share plus $88.82 in cash for each NSC share they own. I mean, it's a complete reshaping of the company if it goes through.
And what are the huge hurdles, the regulatory hoops they have to jump through for this deal to actually close?
Well, beyond needing approval from both companies' shareholders, which is standard, the big one is getting the blessing of the Surface Transportation Board, the STB. The STB is the federal agency that regulates railroads in the U.S., and their review process is notoriously lengthy, highly complex. They look at everything: competition, public interest, the logistical impacts. It's a major review.
And that merger agreement, it had an immediate, tangible impact on NSC's financial operations, even before any regulatory decision, right?
It did, yeah. One of the clearest examples is that NSC had to explicitly suspend all its share repurchases. Just stop them. The merger agreement basically prohibits buybacks without Union Pacific's okay. And that's significant because NSC still had, I think, $6.3 billion authorized for buyback on the books, but that activity is now effectively frozen while this plays out.
And on top of that, management seems to be bracing for some pain from just the announcement of this mega merger, at least in the short term.
Absolutely. The official outlook from NSC management, it explicitly noted they expect competitor responses to the merger news to negatively impact their volumes, both short and medium term. Customers are probably already looking at their options, maybe diverting some traffic while this long regulatory process unfolds. There's uncertainty.
Okay, so what does this all mean then? We've looked at these microscopic details of efficiency inspecting 4.2 million axles a day and these massive macro pressures, the environmental recovery, the huge strategic merger.
Well, I think NSC is clearly showing some strong fundamental health in its core business. The evidence seems pretty solid there. You've got that strong underlying merchandise demand, particularly in chemicals and automotive, and they are realizing measurable productivity gains, that 10 basis point OR improvement, the all-time fuel efficiency record. Those are real wins.
But the corporate story you're actually investing in or following, it's just dominated by navigating these two unprecedented forces at the same time. You've got the multi-billion-dollar financial reality of the Eastern Ohio incident cleanup and litigation. And then you've got the execution of this potentially transformational merger, which brings huge regulatory uncertainty and, as you just said, immediate customer deflection risk.
So for you, the listener, you now have this really quite nuanced view of the company, I think. You can understand the tech improvements, the safety stuff happening at that really granular level, while also grasping the sheer magnitude of the corporate restructuring happening at the highest level.
So here's maybe a final thought to chew on. Given that the ultimate success of this massive merger is so dependent on things outside their control, competitor reactions, complex STB conditions, Well, those operational improvements, the fuel efficiency, the OR gains, they're already delivering results internally. Which factor do you think will ultimately prove more critical for the company's value over the next year? Is it that internal push for efficiency? Or is it the external pressure and uncertainty of this huge strategic change? Something to think about as you track this story.